Well, good morning, everyone. It is 10 a.m., so we will call the March 14th, 2024 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of February 8th, 2024. I have a motion and a second. Please record your vote.
Trustee Janata? Okay. He voted aye.
Item is approved. Okay, item number 3 is a presentation from U.S. Small Mid-Cap Equity Manager, Silvercrest Asset Management Group. Gentlemen, welcome.
Welcome. Thank you.
Good morning and welcome.
Well,
We
good
usually
morning.
we usually try to keep the presentation about 20 minutes, and that leaves us a few minutes for Q&A. And there's Jason.
Right on
You
time.
made it. Okay.
It's a good setup here.
Yep.
Great. Well, I guess I'll just start off by saying thank you for having us in. It's really great to be able to come in and see everyone. I know we were hired not too long ago, back in the fall of 2022. And so I also just wanted to take the opportunity to say thank you to all of you for entrusting Silvercrest and our team to manage your small cap growth equities. So we take that responsibility very seriously and want to just say thanks for that. As a matter of introductions real quickly, my name is Jim Klaus. Many of you probably remember seeing me back in 2022, if not. But anyway, my role is to work with, oversee our client servicing effort and work with all of our institutional clients. With me is Brian Bees. Brian is one of the portfolio managers on this investment strategy. Brian's been managing this strategy since back, I guess, to 2004. So been involved with it since the inception. Steve Lilly, who was here last time, is Brian's partner on the strategy. And so anyway, we thought it'd be nice for you to have a chance to meet with Brian as well. In terms of just an overview, basically on the firm and the strategy, I'm happy to say that we haven't really had any changes, quite honestly, since we were here back in 2022. The team is still the same, no changes there. No changes to senior management at Silvercrest, and really nothing notable to mention in terms of changes with the strategy itself. And so I guess the point I'm trying to make there is that everything's been consistent since you have hired us. And I guess with that, I'll just stop, see if there are any questions for me. Otherwise, I will turn it over to Brian.
All right. Thank you. Thanks, Jim. Actually, kind of go back on the strategy to 2001, so coming up on 25 years. Where'd the time go? But thanks. I thought in the essence of time, I'd hit on a couple of slides, a couple of really pertinent points about how we performed since you've hired us, and put it in the context of what we do, what we've always done in our style, and then what we're kind of looking forward to for the future. So if you could have you flip to slide 9, just a quick reminder of what the small cap growth strategy at Silvercrest is all about. And I know when Steve came here 16 months ago and pitched the business, he made this very clear. We are early investors in small, innovative companies. We're trying to find companies that are using innovation to develop a better way to do whatever their industry is trying to do, and slowly but surely bring it to market. And the way the formula goes is innovate, sell, ramp sales, profits follow. And like I said, innovation is the key, so we're often finding ourselves in technology and healthcare, some consumer stocks. But one of the things I think the investment consultants and the investment community likes about us is we never deviate from that. Regardless of the economy, regardless of what's in vogue in the stock market, we're always going to provide a fully invested portfolio of these small, innovative companies that are trying to change their industry through something new. And we apply this consistently, and so oftentimes our profile is the same, and the market favors different things at different times. So let's kind of review a quick narrative of the year 2023. When we were exiting 2022, which was a very difficult year for stocks, small cap stocks were down about 20%. Our style, we kind of felt like we dodged a bit of a bullet. You know, we outperformed the market slightly. We were still down 20-some%, but it wasn't outsized relative to what our asset class was doing. And we looked at 2023 as maybe this is going to be a lucrative year. Small caps have really been underperforming for quite some time. Maybe the Fed will give us some relief. Maybe the economy is going to find a bottom. And it's going to be an up and to the right kind of market for us, for our asset class. I'm glad to say it was a positive market. Your account grew, and it was a pretty good year for small caps, all things considered. On a relative basis, we didn't fare so well. And so looking back at the year, when I wrote the December letter, I was really surprised at really the ultimate relative performance lag versus our index. The first half of the year kind of went as planned. Kind of thinking, given the style in the marketplace, we should have trailed a little bit given that consistent adherence to small cap growth companies. But then the third quarter was a really difficult quarter. August through October was just so brutal on anything innovative, anything small, anything that was built to grow in the future. So why don't I have you flip to page 13, we'll get into some details. So you can see there, our index, small cap growth stocks, were up 18.5% roughly. And we were positive, around 7%, but not to the standard that what we would like. First half, like I said, was a positive for the market, and positive for us, just not as positive, and then that really bad third quarter performance. So if we look back at the market, it really, the crux of our fourth quarter year-end letter was, it was a very abnormal market. You all know about the Magnificent Seven. 7 stocks drove a majority of equity returns. Large caps were really defined by those 7 stocks. They just kept going up. It didn't matter what the valuation was for those stocks. And that kind of that feeling, that attitude kind of trickled down into the small caps. There was really no interest in looking forward, like I said. The market was really concerned as interest rates were rising from Fed action and rose towards 5% in the fall. Investors were generally not concerned about next year or the year after. They wanted to know, what are you giving me today? What are our profits today? What is our cash flow today? And our style is a little based on, like I said, based on looking forward, based on tomorrow. So we really felt the pain of large caps and near-term cash flow with no interest for the future. The investors were paying for visibility at any price. So valuation didn't really matter if you were giving the market what it wanted right here, right now. And kind of characterize that as all macro. The market was focused on macro, wasn't very interested in what's that company doing to make the world better. How is that company improving its fortunes? So if I can have you flip to slide 15, you can see from a sector basis, how it went for us. So, like I said, we're relative. We really kind of measure ourselves in relative performance. So this performance is nothing that we're particularly proud of. But there's a story here, and there's some hope and some promise. So you can see where our pain was greatest. The healthcare sector, which has always been one of our favorite sectors for finding differentiated, innovative small companies, was really, really difficult for us last year. And there's a story. So coming out of the COVID experience, all things related to healthcare procedures were under pressure. Surely you've read about it. Non-COVID patients weren't really welcome at the hospitals. Procedures were way down. There was a severe burnout from the professionals, nurse shortages, and after 2 years of COVID, A lot of people were leaving the business or taking extended vacations, just taking a break. As a result, heading into 2023, these volumes of procedures that we're going to talk about in medical technology, things like diabetes or heart procedures or replacing knees and hips, those were really deferred coming into 2023. And this is one of our favorite areas, so we felt it. But in the spring, we started hearing about a big rebound in these procedures coming back. In fact, a big national insurance company, United Healthcare, had a really bad first quarter last year because there were so many procedures that they had to write checks for. So we thought, game on. So in April, May, June, we started putting more of these stocks into the portfolio. And then upon reporting their results in the second quarter, generally good results, the stock started to weaken on us. And it was really frustrating because they were giving us what we wanted from a fundamental perspective, and the stocks were going down. And the stocks were going down a lot. It was really painful, and you can see the net result here. What was going on was the emergence of the GLP-1 drugs, the weight loss drugs, Wegovy and Ozempic are the brand names. Surely you've all heard of it. And so this narrative went through the market that if we cure weight loss, we'll cure everything. You won't have bad hips, don't need to replace those. Heart disease will go way down. Diabetes will be cured. So these stocks that we're investing in for the future were just thrown in the trash. And it really impacted the performance to the tune of about 500 basis points in healthcare alone for us last year. Like I said, this is one of our secret industries to find really good, innovative, profitable growth companies. Steve does healthcare for us. I can't stand the sight of blood. They're not really my cup of tea. But he said, we knew this was temporary. We knew this was hype. Weight loss will not cure, it's not snake oil, but it's not going to cure everything. And so we just sort of endured it as a position in the portfolio. So now we're hoping it starts to come back, starting to see some of these stocks get a bid, which is great. So let's talk a little bit about, okay, so that's kind of the story. One more thing to point on this page, and this is where we turn to maybe some optimism. If you look at the far right column is kind of the ultimate scorecard, the bottom line from a sector by sector basis of how we did. It tells us, were you in good industries? Did you pick good stocks in those industries? Did you pay the right prices for them? And in a normal year, you got some winners, you got some losers. But this result, where we're pretty much negative in every sector, does not mean we don't know what we do. We've been doing this for 25 years, so we've seen this before, and we'll transition to that. It's a little bit of a clue. It's a little bit of like, I guess young people call it Easter eggs. Like, when we get negatives across every sector like that, it usually means it's not about our acumen in picking stocks. It's not about our research, it's about our style. When across the board we see these numbers, our style is under pressure. And that pressure, like I said, it's consistent, it's well defined. We're smaller than the index because we like innovative small companies. We're growthier than the index. Our companies are investing in their great tomorrows, so they don't have as much profits today. They don't have dividends today generally. So that's a consistent thing that we bring to the market. And when the market says, we don't like that in healthcare, we don't like that in tech, we don't like that in industrials, again, it's not about the stock picking, it's about the kind of things, the kind of portfolio that we build. So these periods tend to be brief. These periods tend to shine for us on the way out. And the reason is because we're not going to change what we do. We're going to continue to find those medical tech companies that are going to change the world. We're going to continue to invest in technology stocks that have long growth futures ahead of them. We're still going to apply a thematic approach to what we do. So let's put a little bit of confidence behind that. If you flip back to slide 14, you'll see our long-term performance. And a couple of periods I'd like to point out that kind of resemble what we went through last year. The first one it was really 9 months mostly in 2014 into January of 2015. You can see the relative performance in those periods for us. We were down 8%, the market was up 5% in 2014, for instance. Kind of going back and remembering that nightmare, I went back yesterday and recalled the market was very defensive at that time. The US economy was pretty strong, but globally it was really quite weak. And I found some documents we were going through. We'd look at all of our companies to see what your international exposure is, because the market was really freaked out about that, really worried about that at that particular brief time. In fact, companies that were growing fastest did the worst in the market. From the letter we wrote back in 2014, stocks that grew less than 10% were up 9% that year. So slower growers, up 9%. The good ones, the ones we like to find, market when they were growing more than 20%, those stocks were flat for the year. So the market did not like growth. And we got caught up in that. We felt it because that's the portfolios that we build. One interesting thing about that experience was one growth sector really worked. It was biotech. We did not have biotech in 2014. Steve told you when he was here back in 2022 that we rectified that. We now have a biotech component in our portfolio, so we saw that kind of gap and we corrected that. But then if you looked at the back half of 2015, 2016, the market finally cared about growth again, and they came back our way. Kind of a similar story in the first half of 2019. The aggregate performance for the year was we trailed the benchmark by 6%. We were up 22. The benchmark was up 28.5 in 2019. Most of that was in the first half. Worries about a trade war meant that the small cap stocks were going to be left behind, and they really got hammered. So having a small cap bias hurt. In the 12 months of 2019, the S&P outperformed the Russell, the small caps, by 14%. One of the greatest differences of all time, up until recent times when large caps have really taken it to small caps. So we're going to stick by this playbook. It's worked several times in the past. Lots of pain on a relative basis for short periods of time. There's only one thing we could do about it, and that would be change what we do. And we don't do that. We kind of wait it out. We kind of cut off some risk areas on the margin, and knowing that we'll be there when what we do, what's worked for the stock market for 100 years, comes back in vogue. And here's some proof. The market bottomed in October, the second last day of October last year. And really, this is when then interest rates were kind of on their way back down. The market got interested in the Fed pivot, the Fed being a little looser in 2024. We'll see if it happens. It's kind of been a little cold water thrown on it lately, but the proof is in how our portfolios performed for those periods. October 27 market bottom to the end of February. We kind of got what we're all here for. The market was up, our benchmark, let's just talk about your portfolio. Your portfolio was up 32.5% over that time frame. Besting the market. Again, we were starting to shine on a relative basis. Those healthcare stocks we talked about, the healthcare stocks in your portfolio are up almost 50%, 46.5%. Tech stocks are up 39%. It was good to be growthy. It was good to be in these sectors. It was good to be smaller cap. I kind of wish every month would be like this, but we know it's not. And March has been a little shakier because of what I said, the ideas of 6 or 8 cuts being a little bit cooler. But this is the proof that this strategy does work when things get a little more normal. It could display multiple periods of really strong performance because of the adherence to the style. A few things we're interested in or excited about for the rest of the year, and I'll wrap it up and offer some questions. If you turn to slide 20, We do have a thematic angle in our portfolio. I know we talked about that. This is a way for us to find really good growth ideas before a lot of other people do. We find these undeniable trends, these themes in the market, things that we know will happen regardless of Fed policy, interest rates, economic growth. We can identify these things and then use that framework, that tailwind, to try to find some interesting new companies before others. So here they are. Like, for instance, in the middle of that top of the middle column, not your father's Oldsmobile. This is just a realization that we're not building cars like we used to. They're electric, they're autonomous, they have more technology, more entertainment. That was an area that was kind of difficult last year. A lot of cold water thrown on electric vehicles. They were looking out forward to the future, so they were under pressure. Right now, the market's trying to figure out what the future of EVs is. But we still think the cars are going to be more technological, have more autonomy. So there's still a place for this theme, and we're still going to populate new ideas, probably at cheaper prices given all the turmoil.
What do you have in that today, Brian?
Today we have a company called Allegro Microsystems, which is just helps put sensors around the entire car so it can see whether it's for backup camera or hands-off driving. They're just gaining more market share. There's a company called Aspen Aerogels. That's a company that has a really proprietary foam insulation that you put around the battery cells so that if one battery cell catches on fire, the entire car doesn't catch on fire. It's got a very broad contract with General Motors, which is just starting to kick in. Off the top of my head, Jason, that's all I've got right now. There's more. I can look it up, but in the essence of time. So we're probably more in the rebuild stage right now. After seeing a bunch of these stocks come down, we sold out of some stocks out of the pressure of EVs, and then we'll kind of wade back in. What you're not going to find us doing is taking positions in these auto companies that have nothing but promises. You know, we're going to redesign a car. We haven't built one yet. That's not a kind of a risk profile that that entertains us. We're not going to be there. So I kind of walked around the office yesterday, talked to everybody, like, what are you excited about for next year? Consumer analyst Jennifer said, well, we got a pretty healthy consumer. They kind of got their revenge travel out of their system, coming back, sort of surprisingly still in pretty good shape despite the inflation. So there's more spending going into their homes now. So we put a name or two. We put a company called Our House in the portfolio that sells furniture. Roger, our tech analyst, he's really even more excited about the manufacturing renaissance we should have in this country. Not only is it, he was visiting with a cement company yesterday. It's not only dollars from Washington for CHIPS Act and IRA, but it's also private investment coming back here. That supply chain experience scared the heck out of everybody after COVID, and so just more and more building, more and more domestic sourcing or near shoring, be it Mexico, is coming aboard. The tech guy says, I'm really excited for people to spend money again outside of AI. I know you're all familiar with AI. We have a lot of exposure to AI in the portfolio. It's more secondary exposure. And we've had this in the portfolio for 6 or 9 months. I've got I keep track of it on a weekly basis, and I thought this was kind of cute. It's AI and data center exposure, so I kind of ripped off this logo from a famous Australian rock band. So this tells me what our exposure is to AI and data center is every week. And so we've got some exposures there. And I do financials. Pretty excited about what we're seeing in the stock market right now. IPOs are coming back, and we hope M&A comes back. And so one of the larger companies that you own in your portfolio is called Stifel Nicolaus. I'm sure there's an office or a few in town here. They do wealth management. They also do capital markets work. Their capital markets work in the last 2 years went to basically zero. They didn't fire people. They still have all that cost, They just need to start getting deals going to get paid. So we think there's a bright profile in that part of the portfolio. So yeah, unfortunately, we've seen this before in my career. The market doesn't go up 1% a month. It takes you on a ride. And Steve and I have been doing this consistently with the rest of the team. We know the playbook. We know it takes discipline. We know we've got to stay the course, cut risk down where we can, but still present you and all of our other clients an innovative, growthy portfolio, and the market will come back and find it. So that being said, anything I left out, Jim, or open up to questions?
Anyone have any questions? Okay. Well, again, we appreciate you coming down and showing up and giving us information on your portfolio, and
Thanks for having us. Thanks for your support.
we appreciate what you do for us.
You got it. Any
Great.
questions,
Thank you,
you can funnel
everyone.
them through Jason, and he'll find us. Thanks.
Okay. Item number 4 on the agenda is the consent docket. We have 2 items. Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We have 2 items. I have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the claims docket. I have a motion and a second. Please record your vote. Item is approved. Item 7 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. I have a motion and a second. Please record your vote. Item is approved. Okay. Item 9 is to receive report of death, authorize payment of $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Okay, item 10 is to approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item number 11 is to approve the request of the following to terminate vested rights and commence retirement benefits. We have a motion and a second. Please record your vote. Item is approved. Okay. Item number 12 is items for individual consideration. Item 12A is certification of delegation of authority designating both Gina Jordan and Jake Siebenaler to act on behalf of the Oklahoma City Retirement System. Does anyone have any questions? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. Item 12B is form incumbency certificate designating Gina Jordan as authorized signatory. Any questions? I have a motion and a second. Please record your vote. Item is approved. Item 12C is form incumbency certificate designating Jake Siebenhaler as authorized signatory. We have a motion and a second. Please record your vote. Item is approved. And item 12D is approved sending Gina Jordan to the GFOA Annual Conference, June 9th through 12th, 2024 in Orlando. Any questions? We have a motion and a second. Please record your vote. Item is approved. Item number 13, receive a monthly investment consultant report. Good morning, Jason.
Morning. Sorry, I was a couple minutes late. Ohlers
You got in just under the wire.
moved their meeting.
Good job.
So just as we talked about last month, we just want to get in the habit again of having some managers come in just to give updates, and we put a schedule together. And the first one we thought we'd have come in was Silvercrest, who's really your newest manager. So Silvercrest replaced Times Square a little over a year ago in October of 2022. You had Times Square for a number of years. They had quite a bit of turnover. It's a smaller firm. They had PM, assistant PM leave, and then some analysts leave on the team. And so we made a change to Silvercrest to complement Ernest in your small cap portfolio. Ernest being more of a relative value manager, and Silvercrest, as you heard them describe again today, a small cap growth manager. It's always a challenge when you're looking at your own performance report when a manager doesn't get out of the gate quite as strong, because you lose all of the history as to why you hired them. You don't see that in your report because last year was a pretty challenging year on a relative basis. Despite being up 7%, the benchmark was up 16, 17%. But if we look back on a 5-year period through the end of the period that they're showing, the 5-year return for that portfolio net of fees has outperformed the benchmark by 270 basis points. They've done a good job for their investors over time, and we continue to believe that they will. A couple of things just to highlight again. I mean, he talked about the healthcare exposure. The other thing to note with them is they are going to be typically a bit smaller than the small cap benchmark. He noted that, and in their material you can see that their average weighted market cap is about 2.8 billion, where the benchmark is about, the average is a little over 3. If we dig into that a little bit further, within the benchmark, there is 20% of the holdings in the Russell 2000 growth are below 1.5 billion. They have on average over 30% under 1.5 billion. So they move down pretty small, which we also think is a good complement to Ernest, who it's a SMID strategy. They tend to let the winners run and move up a little bit more market cap. So again, I think we have Ernest coming in next month, your other small cap manager, more value oriented. These are just updates. We don't have concerns, so thought we'd start with them. So looking at the February report, if we go to the market snapshot, in the upper left there, we're showing the dark blue bars are the month, and the light blue bars are year to date, which is just 2 months. So it's January and February of this year. A couple things stand out here, still through the end of February and through the end of March now. Large cap continues to outperform on a year-to-date basis. The S&P 500 up 7.1% through the end of February. I think it's like 8.5% through today. And small cap up about 1.5% through the end of February. It's about 2.5%, 3% through today. So large cap still about double. And within large cap, it's really continues to be large cap growth. We are seeing a bit of a broadening of participation beyond the Magnificent Seven, but those stocks certainly continue to do very well. You will notice in the month of February. Small cap did a little bit better than large cap. Small cap was up close to 6% for the month, and large cap was up 5.3 for the month. Non-US, fairly tepid returns. Emerging markets had a good month. International developed not up quite as much. We always try to put what we consider to be some interesting data or facts in the lower right each month. And this chart has been, we put this here because we've been getting a lot of questions just about the run-up in U.S. large cap, and should we be taking more chips off the table? And our primary answer, we're always going to say, is yes, we should always be rebalancing back to targets. If you've established a target asset allocation and we're running up above that, we should be using that, not eliminating it, but taking some chips off the table and rebalancing into what's underweight, or for your purposes, generally the rebalancing is to meet your operating cash needs on a monthly basis. But that said, some folks want to take it a step further and say, well, I'm really concerned about large cap. Should we be putting some hedging strategy or really moving the other direction? And we did some work just going back to 1954 to now, looking at trailing returns from market peaks. And what this is telling us is that really when we've hit market peaks, we've generally continued to go up. So the 12-month, the bars on the first on the left side of that chart are showing the light blue is following the 12-month period following an all-time high. So on average, following an all-time high, the next 12 months, the S&P 500 is up 8.1%. All other periods, going back to 1954, it's about 8.8%. So a little bit less, but not much less. The next 2 years, and these are cumulative, not annualized, following a market peak, we've seen the S&P run up another 16%, and 3 years up 28%. So that's about 9% annualized following market peaks. So again, we're not showing this to say we need to continue to follow the momentum, but it's just for those that are saying, well, should we be doing something more, taking more risk off the table? And we're going to always have the same answer. We're going to stick with the strategic asset allocation, rebalance back to targets, take some chips off the table, leave a little bit there to continue to participate. Looking at your portfolio on the next page, we are a little bit overweight within equities. Large cap is overweight. We would recommend doing a little bit more rebalancing here. We've done we've got redemptions on the long short equity. So we've got full redemption. That 5% is coming out, as we talked about. When that money starts to come back, which it will in the coming months, we're going to be reallocating that into fixed income. In the meantime, we are taking from large cap and for your operating needs on a monthly basis. We are quite a bit underweight to private equity. You see there, we're at 6% underweight to private equity. Within the policy, if we looked at your large cap equity at 25.67, it's over the range at 25. The policy does reflect that the unallocated portion of your private equity is held within large cap. So it's not as egregious as it looks there. But nonetheless, we are doing some rebalancing. It's just going to take time as we're taking from some of those less liquid funds. From a portfolio performance standpoint, looking at the next page, on a one-year basis, through February, net of fees, the fund is up 10.4% relative to the policy index at 12.35. Really the things, and I know it sounds like a brokered record, it's a couple of things that are really leading to that dispersion relative to the policy index. The policy index is 35% of the policy index is the S&P 500. So we're assuming you're in the thing that's doing the best. And that's representing not only the large cap allocation within the policy of 18%, but private equity and long-short equity up until now, even though that's coming out. Private equity, if we go down, you'll see on a one-year basis, your private equity is up 6.2%. So relative to the S&P 500, which is up 30.5% roughly, and that's about 9% of your portfolio, most of that dispersion on a one-year basis is coming from private equity. Longer term, your private equity is doing what we would expect. If we look at the 10-year return for private equity, it's up 14% relative to the S&P, up 12.7%. So you're getting over long periods of time that premium for the illiquidity. No specific manager issues. Like I said, we've got a schedule together now where we're going to have most of your long-only equity managers in over the next 8 months or so, just to get updates from them. The redemptions from long-short equity are occurring. It'll really money will start to come back. I think it's really after the June period when that money will start to come back from those redemptions. Any questions on the monthly report?
All right.
Okay.
Well, thank you, sir.
Thank you.
Chair will entertain a motion to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. Item number 14 is comments from board, staff, and citizens. I know a lot of us that work at the city already know Gina, but for those of you that are not city employees, this is Gina Jordan, our new manager. Say hi. We've gotten over the first big hurdle with Michael and Mary Ellen's help. We got the first agenda done when she was a new director, so it's all smooth sailing from here on. So I just wanted to recognize her and, of course, Mary Ellen and Michael for the great job they do for us. And Matt and our esteemed municipal councilor, Mr. Mahoney. So, okay, we are adjourned at 10:42. Thank you, everyone.